where we help sharpen strong work and maximize its impact.
Good to be here.
So, today we're diving into an analysis report on CRCL, that's Circle Internet Group.
The engine behind USDC, yeah.
Exactly. And to frame this, the core argument is that CRCL is, a deeply undervalued crypto leader. It's a classic market dislocation story.
Right, record numbers, but the stock price is just...
Not reflecting it.
Not at all. A 70% drop from its peak.
Okay, so right off the bat, what I really like is the data in Section 2. It's just so decisive.
It is.
You've got Q3 2025 performance laid out, $740 million in revenue. That's up 66% year over year.
And the pivot to profit, that's the real story.
The huge pivot, $214 million in net income. It makes a really strong case for a mispricing, highlighting that massive EPS beat.
Yes, 64 cents versus the 19-cent estimate. You can't argue with that.
You can't. The numbers are rock solid.
They are. The data is compelling, almost overwhelmingly so. Which makes me wonder, though, if we've considered how presenting such a strong bullish case could actually be made stronger by acknowledging the other side.
What you mean?
When the data is this good, the challenge isn't just proving the good news. The challenge is explaining why the market is so wrong.
That's a great point. And that's really the pivot for this whole critique, isn't it? Optimizing the impact, moving beyond just the excitement of the numbers to make the argument airtight.
And to be airtight, it has to be complete.
Okay, so let's start there. To fully validate this whole dislocation thesis, the analysis report really needs to dedicate some space to robustly addressing the specific concerns that caused that 70% crash.
Right, the drop from 298 down to 87.
Exactly. The material sort of claims the market is lying or that the crash is just fear, but, it never says what the fear is.
And that's the weakness. It feels like a strategic omission of the bear case.
By ignoring the counter-arguments, it misses a huge opportunity to show how resilient CRCL's fundamentals really are.
I agree. You risk looking like you've only focused on the good news, which might make a skeptical reader think you haven't really pressure-tested the thesis. That initial 298 price was, it was euphoric.
For sure.
It is. If you don't engage with those specific fears, a reader might just assume you don't know what they are.
That's a fair point. But is there a risk that if you give too much space to the bear case, you, water down the conviction? The numbers are so good, why debate fear?
Because credibility is built on what you choose to confront, not just what you highlight. If you want a professional investor to trust a $140 price target, you have to prove you've already considered the worst-case scenario. You acknowledge the risk, and then you crush it with the data. It makes the analysis feel less like a pitch and more like a comprehensive rebuttal.
I see. So, for an improvement, what are we thinking?
A dedicated section. Something like, why is it $87? Confronting the bear case. You present the market's risks, and then you dismantle them one by one.
That frame of intellectual honesty would immediately boost the report's standing. It signals that this isn't just cherry-picked data.
Precisely. For example, you could explicitly address the big structural headwinds, like increased global regulatory risks for stablecoins. You have MiCA in Europe, the ongoing confusion in the US.
Or the threat of central bank digital currencies.
Exactly. Those are the things that justify the market's pessimism. But then you hit them with the $73.7 billion in USD circulation growth. You hit them with the Visa partnership.
So the argument becomes, the market fears X, but CRCL's operational scale and this huge validation from Visa prove there's an insurmountable moat.
Yes. You prove the valuation is too low despite those acknowledged risks.
Okay, that's powerful. Let's shift gears a bit to presentation style. Because, ironically, this is where a really convincing analysis can sometimes stumble.
The tone?
The tone. So, the persuasive power of all that excellent financial data is, I think, slightly undercut by a very high-energy, almost sensationalist tone.
I know what you mean. The high-energy, contrarian vibe.
Yeah. Which can work sometimes, but the material uses phrases like calling the revenue stream a money printer. It tells the reader to load the boat and calls the dip a gift.
Right.
And the weakness there is that this language it clashes with the very mature, detailed financial data. You have $740 million in revenue, and then load the boat. It might diminish the report's credibility, especially with experienced finance pros.
That is the classic analyst's dilemma, isn't it? You have the facts. The Q3 numbers are undeniable. But if you shout the conclusion, sometimes people stop listening to the evidence that got you there.
Exactly. You pair a forensic breakdown of the EPS beat with load the boat, and the sophisticated reader might feel the conviction is coming from emotion, not disciplined analysis.
Yes.
But in such a crowded space, don't you need a punchy tone just to cut through all the noise? Is there room for that kind of enthusiasm?
There is, but it should be delivered through precision, not volume. The data itself is the sensational part here.
That's a good way to put it.
The jump to $214 million in net income, that's the scream. The language should reflect the seriousness of what CRCL is, a foundational fintech leader, validated by Visa, not just another speculative crypto play.
So the suggestion here is to maintain that bullish conviction,
Absolutely, the numbers support it.
but transition the language from, say, contrarian hype to more professional validation. Let the metrics themselves be the emotional drivers.
Yes. The language should just confirm the gravity of the business model.
That shift is vital, especially when you're talking about a business that has $73.7 billion in circulating assets.
So, for concrete examples, instead of calling it a money printer, maybe rephrase it. Emphasize the high-margin, scalable revenue stream derived from reserve interest.
It's just as powerful, but it sounds professional and quantifiable.
Exactly. And instead of load the boat, you could use a more refined call to action, something like aggressive accumulation within the $80 to $90 range.
Framing it as accumulating a proven cash flow engine at a discount.
The message is identical, but the tone maximizes credibility and trust.
Excellent. That lets the data do the heavy lifting. Okay, so let's dig into the section on technical analysis. This is crucial for actually acting on the thesis.
Right.
The report presents these highly detailed fundamentals, but then it offers a relatively brief and isolated view of the technicals. It makes the entry points feel less rigorously supported.
The depth just isn't there compared to the fundamental breakdown.
It isn't. The weakness is that Section 4 focuses very narrowly on just one day's price action, this flush and reclaim on December 22nd. It only gives two levels, $86 support and a $91.20 trigger.
And that's it.
That's it. And that abrupt shift with so little context, it just weakens the conviction behind the entry strategy.
That is fascinating. You have this moderate buy consensus, an average target of $141, presumably from a detailed DCF model, and then the whole execution strategy hinges on a single 24-hour candle pattern.
Yeah.
Is the connection between that daily setup and the long-term fundamentals really established? Because right now, it feels like an appendage, like it was just tacked onto the end of the valuation.
Exactly. If the point of the TA is to find an optimal entry, it has to prove the price isn't just temporarily cheap, but structurally cheap, a price zone defined by significant history.
So for an improvement, the analysis has to integrate the technicals more structurally, maybe weave them directly into the discussion of the analyst price targets in Section 3.
So not necessarily expanding Section 4 into a huge deep dive.
No, I think that would dilute the report's strength, which is the fundamentals. Integration is more efficient. You show how the current price actually confirms the moderate buy consensus because it's sitting right on a long-term accumulation zone.
By weaving the levels into the valuation discussion, you show that the smart money you mentioned is acting on multi-month structures, not just daily noise.
Exactly. You prioritize the larger structure over intraday fluctuations.
So what's a concrete example of that?
Well, link the entry point to historical significance. The report mentions the IPO price was $31. Instead of just calling $86 a single bear trap, explain how that level relates to a larger multi-month support structure. Maybe it was the prior range high before the explosive move up to $298.
Ah, that immediately gives the $86 level more gravitas.
A lot more. And then, to confirm the reversal above $91.20, you could add a brief look at a secondary metric.
Like what?
Like relative volume trends on that reversal day, to show that institutions stepped in. Or maybe a momentum indicator, like the RSI defending a key historical level. Something that signals the smart money accumulation you already talked about.
That would prove the entry is calculated and supported by history, not just a daily whim.
That's the goal.
We've covered a lot of ground here. So a key theme seems to be about optimizing the report's overall impact. It's about matching the professional quality of that decisive Q3 data with an equally robust analysis of risk and a more refined tone.
The core thesis is powerful, no doubt, but the delivery can be refined to be truly institutional grade.